Hi, everybody. We are back with another finance-related segment here, and in this brief video, we are going to discuss a concept known as the yield curve, which is a visual representation of something we refer to as the term structure of interest rates, and I will elaborate on that in just a moment here. So in this segment, we're going to take a look at one of the most important tools in finance, which is something called the yield curve. The yield curve, much like a stock market index like the S&P 500, for example, is a tool that is used to summarize the health of the bonds market, or really the health of the loans or interest rate market. Again, this is very similar to how you might look at, like the S&P 500 or the Dow Jones as an index to think about the overall health of the stock market. The yield curve is sort of the counterpart to that, but from the bonds market perspective. The yield curve, again, helps us observe what is known as the term structure of interest rates. And this is really how the interest rate paid on a bond changes with the maturity of the bond. So we could think about short-term bonds that may be finished making payments in 1 month and 30 days versus 3-year bonds, 5-year bonds, 7-year bonds, or maybe even like 20 or 30-year bonds, which are much more long-term bonds. But we could compare for similar risks, the annual interest rates paid on those bonds versus the maturity horizon of those bonds. And what we would generally observe here in a moment is that in a well-behaved economy, in a normal term structure situation, that the yearly return on long-term bonds is generally a little higher than the yearly return for short-term bonds of the similar risk characteristic. This tool, the yield curve, is useful because it can help make predictions about the behavior of financial markets. So let's go ahead and take a look. So here is a picture of a yield curve. And a yield curve is taken at a snapshot in time. We'll look at the dynamic yield curve momentarily. We can actually see this thing change over time. But this is the graph for a given point in time that measures the annualized interest rate on a bond, right? The rate of return on a bond, or the yield of that bond on the vertical axis. And along the horizontal axis, we're measuring the maturity horizon. How long does it take to receive all the payments that the bond pays? And specifically, we're looking at this picture from the perspective of various government bonds in this diagram. So for example, here is the rate of return on a 3-month government bond, Treasury. Here's a 2-year return. Here's the yearly return on a 5-year bond. Here's the yearly return on a 7-year bond, okay, the 10, the 20, and the 30. All right, note that in this picture here, it looks like as we increase the duration or the maturity horizon on the x-axis, then it looks like on average the yield is increasing along the vertical axis. The interest rate being paid on the bonds is increasing the vertical axis. It's also important to recognize here that we're graphing government bonds, which are all considered to be what are known as risk-free. It is really not totally risk-free. The government could default, but that's very low probability. So this diagram is graphing bonds that have equal risks. Okay, in terms of default, they have equal risks, but it looks like they have different rates of returns at different maturity horizons. Okay, and we expect that a well-behaved yield curve should slope upwards due to a phenomena that economists refer to as liquidity preference. And just note here, I pulled this from just a couple days ago. So this is the current term structure of interest rates. 30 years paying up here. And the 3-month is paying pretty close to 0. So let's talk about liquidity preference theory for a little bit. The theory of liquidity preference suggests essentially the following: that people prefer assets that are more liquid to assets that are less liquid, holding other factors fixed. And by those other factors, of course, we're referring to things like the rate of return, risk, etc. So what this implies here would really be the following. If you were considering a choice between putting our money into two different investment options, the first option is a 30-year investment that pays an annual rate of return of 5%, versus putting that money in a 1-year investment that also pays an annual return of 5%, given that both options are equally risky. Okay, so both options have the same return, and they both have the same risk. Liquidity preference theory would suggest that if you offer this choice to people who satisfy the axiom of liquidity preference theory, that everybody would prefer the 1-year option against the 30-year. Everyone would rather jump into the 1-year investment. Nobody would want to jump into the 30-year investment, provided we could repeat that 1-year investment over and over again. So liquidity preference suggests that people will prefer the 1-year option because it pays us back only after 1 year, and it frees up our funds to maybe pivot towards an alternate investment after, again, only waiting 1 year. In fact, if we wanted to, we could just keep rolling over the 1-year investment 30 times to generate the same long-term rate of return as being paid on that 30-year investment. But the 1-year investment at least provides us flexibility. And every year we have the option to not reinvest and to pivot and do something else potentially. So the implications of this theory here is the following. Okay, it implies that if an investment is going to tie up funds for a longer time horizon, then an investor is going to need to be compensated a higher rate of return since they've lost a little bit of liquidity. Okay, so if I'm going to offer you an asset that ties up your money for a little bit, and then I give you an alternative investment that ties up your money for much longer, if those investments are equally risky, then I would need to compensate you a higher rate of return on the investment that is tying up your money longer. Okay, so this suggests that a normal term structure of interest rates that are consistent with the theory of liquidity preference really implies that long-term bonds that have longer maturity dates should be paying a higher annualized rate of return compared to equally risky short-term bonds that have shorter maturity dates, which pay you back faster, right, which free up your funds faster. And again, this is accounting for the differential in liquidity between the long-term bonds and the short-term bonds. So that picture we were looking at earlier, this is a normal term structure. Okay, the yield curve on the right is capturing a well-behaved yield curve situation consistent with this theory of liquidity preference. As the maturity horizon increases along the x-axis, the annual rate of return being paid on those bonds is also increasing with accordance to the predictions of the liquidity preference theory. In the next slide, we're going to take a look at an atypical term structure. So this is something funky. This is not really a well-behaved situation. So this diagram on the right side here shows an atypical term structure associated with the yield curve that has some portions of it that are downward sloping. Okay, we refer to a yield curve that is generally downward sloping like this as an inverted yield curve. And in this particular situation, when you have an inverted yield curve, this says that some of the short-term bonds are actually paying a higher rate of return than equally risky, less liquid long-term bonds. Now, if that's the case, then it almost seems like you can have your cake and eat it too, right? The short-term bonds are paying more and they're more liquid, which raises the question, why would anyone want to buy the long-term bonds in this type of situation? All right, we argue that everyone will just want the short-term bonds. Nobody wants to buy the long-term bonds. So if we run into a situation like this, we typically see the following propagation mechanism kick in. And that is when the short-term bonds look more attractive across the board, investors only want to buy these bonds. They rush to buy these short-term bonds. And that means there's going to be an increase in demand in the market for these short-term bonds, which pushes up the price of these short-term bonds. Everyone's buying, and that's going to drive the price of the bonds up. We'll look at that in a moment. We actually saw that in the last segment on bond pricing. Or actually, sorry, 2 segments ago on bond pricing. And again, remember, the price of the bond and the yield of the bond, the rate of return, the interest rate on that bond are inversely related to each other. So when the price of the bond goes up, that means the bond cost you more for the same future cash flow stream. So your rate of return is now lower. Okay? And as a consequence of everybody buying up short-term bonds, what we typically observe shortly after this type of inverted or flat yield curve situation is we observe a fairly sharp drop in the short-term interest rates. Okay, notice in this picture here, we have a shadow showing you where the values have fallen from, and it looks like most of that shadow is showing us quite a bit of volatility in that 3-month rate there, in that 90-day rate. Okay, but there's a little bit of a drop in some longer-term rates, but most of the drop, the most precipitous drop rather, is at the left-hand side of that yield curve, is under short-term rates. Again, don't forget this principle: when prices are driven up, interest rates are driven down. And we could see this using the bond pricing framework. We actually looked at this in our bond pricing segment. So if we consider the market for bonds, right, and if we thought about this short-term bond situation that now looks more attractive, we argued the number of buyers in that short-term bond market is going to increase, shifting the demand curve for short-term bonds to the right, driving the price of those bonds up. And again, when the price of the bond increases on the left-hand side of the pricing formula, this drives the yield down on the right-hand side of that pricing formula. Okay, so again, the implication of this was that when we see a yield curve that is inverted or flat, like it definitely is in this top picture, that situation predicts or precedes a massive drop in short-term interest rates. And the more inverted, the more downward sloping that term structure is, the sharper the drop predicted in the short-term rates will be. Okay, note that there was a little bit of movement in long-term rates, but most of the movement involved drops in the short-term rates. Okay, so historically, an inverted or flat yield curve has predicted 7 of 10 of the last National Bureau of Economic Research recessions in the United States. So the yield curve is a fairly good predictor here of recessions. There have been a couple instances of false positives when the yield curve inverted and there wasn't a recession. The yield curve in the top panel that we've been looking at here is actually the yield curve just prior to the dot-com bubble bursting, right around the end of 2000, prior to that recession. And the bottom panel, which looks a lot flatter, is the yield curve in its state just prior to the housing crisis in 2007, before we went into that Great Recession. Right now, the yield curve has an important relationship to the stock market in that bonds and stocks are in some sense substitutable assets. Okay, and when the market's good, when the market's bad, consumers wind up playing a little bit of a game of hot potato with their assets. In that, when the stock market does well, people liquidate their bond holdings and they shift them over into stocks where they can make a higher rate of return. Two things happen. The buying up of stocks pushes the price of stocks up even further, and the selling off of bonds reduces the price of bonds, and as a result, we just looked at this mechanism, it increases the yield, the rate of return on those bonds. Okay, conversely, when the stock market does poorly, then again, people play hot potato and they throw that investment out of the stock market, out of the frying pan, and into the bonds market. Now, again, they don't just throw their money into their mattress where they make no rate of return. They put their stocks, or rather the money that was in the stock, into bonds, and they put them into short-term bonds, right, which are more liquid. They can get the money back faster in case they needed to pivot that investment here. So when this selling off of stocks occurs, this winds up pushing the price of stocks down even further. And as those funds are moved into short-term bonds, this buying up of bonds winds up pushing the price of bonds up and pushes the interest rates on those bonds, the yields on those bonds, down. Okay, so again, we saw before, same idea here, right? If people start selling something, if everyone's selling bonds, then the number of sellers in that bonds market is going to increase. Okay, shifting the supply curve to the right, this puts downward pressure on the price of bonds, which results in upward pressure on the interest rate, okay, or the yield. All right, another idea that we're going to talk about here for a moment before we take a look at the dynamic yield curve in its full glory and give you kind of a full history of at least the last 20 years of financial market history, is the idea that beliefs matter a lot. And we, in our finance unit, we've seen this idea that psychology is important, that when people become more patient, present values look bigger. When people become less patient, they look smaller. And people's beliefs about the future can influence prices, even if the beliefs are not correct. And beliefs can cause people to take actions now that can actually create changes in future conditions that lead those beliefs to actually being correct. And this is kind of a very strange thing to study in economics and finance. But this idea that when beliefs change, it causes people to change their actions. And when actions change, this can cause market conditions to change in a way that leads the actions to cause the beliefs to become true. And this is what we refer to as a self-fulfilling prophecy. Okay, so we're going to take a look at the first example here, where buyers believe that the price of the good is going to go up in the future. And if you think something's going to be more expensive in the future, if you're a buyer, you don't want to wait for the future. You now want to, you're incentivized rather to purchase that good now, or that asset now, meaning this increases your demand today. And this belief, when paired with the action or the response to it, which is you increasing your demand today and buying more of the good, this causes the equilibrium price of that good to be driven up. So we look at that new intersection point, new demand curve, same supply curve, and that occurs at a higher equilibrium price. Okay. Similarly, if sellers also hold this belief that prices are going to be higher in the future, then sellers are going to want to do something similar. Okay, that is, if they can make more profit by waiting it out, then they actually want to reduce their quantity supplied today. They're going to reduce their supply today, meaning their supply curve will shift left, and that will put even further upward pressure on the price, exacerbating that self-fulfilling prophecy. So the idea here is that the price went up today because everybody believed it was going to go up in the future. Okay, so people take an action and it causes the price to actually be higher in the future. The beliefs about the price going up cause the price to go up. And we can make a similar argument if the beliefs were in the other direction. If buyers believe the price is going to be lower in the future, then they're going to hold off on buying it now. And this decreases demand today, shifting that demand curve to the left, okay, putting, again, downward pressure now on the price. If sellers also hold this belief that prices are going to be lower in the future, then sellers are going to want to sell now to make more profit. And this is going to increase the supply today, shifting the supply curve to the right. And again, that rightward shift in supply, when paired with the new demand curve as well, predicts an even steeper drop in the price of the good, further exacerbating that self-fulfilling prophecy. Okay, so again, why did the price go down? Well, the price went down because everybody believed it was going to go down. All right, so what we're going to do next is I'm going to share my screen here with you in a sec. We're going to take a look at the yield curve next to the S&P 500 market index, and we're going to animate this visualization and look at the last 20-year history or so of stock market returns and how the yield curve, rather, has responded to changes in the overall equity market conditions. Okay, so here we are. We are taking a look at two visualizations side by side. You'll notice the left diagram should look very familiar. That is the current yield curve, or rather the yield curve corresponding to March 12th, 2020. And you'll notice we can see some shadows above the yield curve here. I can control this trail length to show the past motions of the yield curve. So you can sort of see here that interest rates have been coming down quite a bit as of recent. Fed's been cutting interest rates. In fact, the Fed acts as a very big buyer in the market for these different types of bonds, of government bonds. And when the Fed buys up these bonds, that causes the demand curve to shift right in the bonds market, as we just saw, which drives the interest rate down. Okay, and this is actually, if you take macroeconomics or any course on money, banking, and credit, the mechanism by which the Fed targets interest rates. They buy and sell bonds in order to pin down the rate of return on those bonds by acting like a very big buyer in the market. Okay, so what I would like to do here is show you just a little bit of dynamic history of the stock market, the evolution of the S&P 500 index, which is measured in the right diagram here. So this right diagram, you can sort of see, it looks like along the x-axis, we're measuring time, and we're measuring the year. A little bit different than what the x-axis is measuring the yield curve diagram. In the yield curve diagram, the x-axis measures the yield to maturity on a bond. But the right diagram here is a time series diagram of the S&P 500 market index. The S&P 500 market index, what that is, it's an index that takes the 500 largest companies on the New York Stock Exchange, the NASDAQ, based on capitalization, and it creates a price-weighted average based on how big these companies are in terms of capitalization. So it's 500 of the largest companies on the stock exchange, and the idea is that when these companies do good or bad, that affects this index, and that provides us some indication of the overall health of the economy and financial markets. It's important not to confuse the stock market with the economy. One is absolutely a subset of the other, and the financial market is not necessarily a great indicator of the average economic well-being of an individual. So try not to make that mistake, but it certainly tells us about the health of the equities market, of the stock market specifically. So what I'm going to do here is I'm going to grab this red vertical line in the right diagram, and I can drag it around to show you the history of how the yield curve changes on the right. And we're going to go ahead way back to 2000, just before the dot-com bubble burst. And I want you to take a look at the term structure of interest rates in the left-hand diagram as we move towards the peak of that bull market. Okay, so at this point, we're right at about March 22nd of 2000. We've hit this inverted yield curve situation. Here's May 15th. Okay, yield curve is looking pretty inverted. And at this point, the market was in what's called a bull market. A market was going up. And if you think about a bull and a bear fighting, a bull got to gore the bear up. So anytime the market's going up, they call this a bull market. And when the market's going down, it's a bear market. But in the bull market, people are happy. They believe stocks are increasing in value. And as we saw a moment ago, the belief that the price is going to go up in the future actually drives the price up in the future. And this is something that can cause bubbles to happen. It's people believe something's going to happen. They take that action even though their belief doesn't match with the overall fundamentals. At some point, some folks get skeptical. And you'll notice as people are buying up stocks, what are they doing? Well, they're liquidating their short-term bond holdings. And as they sell off the bonds, this drives the rate of return on the short-term bonds up, right? Price of the bonds is going down as they're selling them, coming up to this point, okay, which means the rate of return gets pushed up. And that's essentially why we're in this situation where the short-term rates exceed the long-term rates. Now, as we move through the market crash here, what's going to happen? Well, people see the stock market starts failing and they change their beliefs about the future. Okay, so as soon as the market starts to fail, okay, people see, oh, everyone's liquidating, market's in a downturn, the stock market's crashing, which means folks start to expect that the future stock prices are going to be lower. If they expect future stock prices to be lower, okay, do they want to hold on to them for the future when they're not going to be worth as much? Answer is no. That changes their behavior now, and it incentivizes them to sell even more, causing even more downward pressure in that market, which is why we see that stock market crash in the right-hand diagram. Now, what I really want you to look at here is when I animate the pane, I want you to look at the left-hand diagram and note how the yield curve changes as we go through the bear market crash in this market correction cycle. So market's crashing, everyone's selling off their stocks. and they're putting that money back into short-term bonds. Notice the size of the drop in the 3-month interest rate here is a big drop in the short-term rates, consistent with this idea that when people sell off their stocks, they put them in short-term bonds, which pushes the price of the bonds up and is dropping the yield as we are witnessing here. And notice that yield drop is pretty precipitous for the short-term rates. They were up there like pretty close to 7%. Now they're down lower than 2.3%. So we're still going through this market crash. And the other thing to notice is that long-term interest rate, that 30-year rate, that's pretty fixed. There's not a whole lot of motion in the long-term rate. Most of the motion was in that short-term rate, right? It was way up high. Now it swings down and it's extremely low, below 2.3%. And then again, we move through this market correction. We hit the trough at the S&P 500 there, and we have now a correction in that term structure of interest rates, right? Our yield curve on the left panel looks very well behaved now in that it's consistent with liquidity preference. The 3-month rate of return is much lower than the 30-year rate of return. And in fact, as we move from left to right in that left-hand diagram, the yield to maturity is increasing as we increase the maturity horizon. Now, as we move forward in time on the right, okay, we still see that well-behaved yield curve. It's still upward sloping for the most part. Okay, but we now start moving into another bull market. Okay, this was our housing price bubble. And what happened there? Well, everybody thought housing prices only go up. That's what they believed. And if you believe housing prices only go up, then what do? You buy now. You don't want to have to buy when they're more expensive. And that action of you buying now pushes housing prices up. So we were stuck in a little bit of a self-fulfilling prophecy in terms of housing prices, but also in terms of equities. And there were a lot of assets tied to housing prices at this point in time. Mortgage-backed securities, a lot of exotic derivative options as well. So the financial market was in some sense really contaminated by the state of the housing market. And also, as we move through the bull market here, you'll notice the short-term interest rate starts to creep up, right? That short-term rate's increasing. What are people doing? Well, they're selling their short-term bonds to get into stocks, right? They're playing hot potato in the other direction now. Stock market's doing great. Let me pull my money out of short-term bonds. So when we do that, right, it drives the price of those short-term bonds down, which means the yield, the interest rate on those short-term bonds starts getting pushed up. And that's what we observe here as we move into 2007, where again, we hit this flat or slightly inverted yield curve situation. Okay, the market reaches the peak here. Beliefs change as the crash starts to happen. And notice almost right away, right, there's a little bit of a drop in the right diagram, right? Stock market crashes. And then people do what? They liquidate their stocks. They put them in short-term bonds. That drives the price of the bonds up, and it starts to drop the yield on the short-term bonds, as again we can see here in the left diagram. Okay, so as we animate ourselves through this precipitous market crash that led to that Great Recession after 2007, okay, note we get a massive decrease in the short-term rate. Now, the other thing I want you to see here is that there's quite a bit of movement of that 30-year rate in this instance, and that was not present after the 2000 market crash. This is also a consequence of the central bank doing something a little bit differently that they hadn't done prior. Okay, in 2008, or rather after the financial market crash, after the housing crisis in 2007, the Fed started implementing a much more aggressive form of buying bonds known as quantitative easing. And they wound up adding to their portfolio assets that were tied to the housing market, things like mortgage-backed securities. And these assets were tied to long-term interest rates, right? What type of mortgages do people typically take out? Well, they're taking out fairly standard is a 30-year mortgage. So when you manipulate the rate of return of these types of mortgage-backed securities, what you're really doing is you're manipulating the long-term rate of return in a way that's trying to get people to buy big ticket items, right? You take out longer term loans to finance big ticket items. like home purchases, auto purchases, major appliances, etc. So note that although that short-term rate did have a pretty precipitous drop, right? It was up there above 4.65, drops way, way below. In fact, hits near close to zero once we get to the bottom of the trough of the S&P 500 here. Hey, look at all that movement in that long-term rate. Okay, a lot of that has to do with quantitative easing. There's a lot of movement in long-term rates here. Okay. And we can go ahead and move forward into the largest bull market that we have seen. Note the short-term rates pretty much stuck at zero. The Fed was being pretty aggressive about maintaining short-term rates. Okay, and we have a very nice, well-behaved yield curve here. Okay, you'll notice right around October of 2018, it flattens out a little bit. Okay, maybe a little bit of signal of trouble here from the trade wars, a little bit of an inversion. Okay, but moving forward, that corrects itself. Fed cuts rates, short-term rates, and we are back to our present-day situation. So hope that gave you a quick look at what the yield curve is, how that can be used to think about forecasting financial crashes, and how that's related to our discussion of bond pricing and equity pricing, as well as the term structure of interest rates. Hope that was informative, and stay tuned.